what we were talking about is what I'm finding, and a lot of people are asking me is, this thing about residential versus commercial. And I've realized I met with a group a couple of weeks ago, and I said to them, yeah, I'm very big on education. I really feel that if you want to get into commercial, you really, really need to get educated. And we've got education programs, and I've been running mentoring programs for quite a long time. I kind of let the mentoring program go for a little bit. But now with this drive, bringing back education. And I think that the biggest thing is people want to know, they want to know more information. And when I mentioned it, I was actually in a room with a bunch of real estate agents, and I mentioned something about education. They went, oh, yes.
Yeah.
And it's amazing because commercial real estate agents don't even know half the stuff that they should really know to be selling commercial properties.
Okay, that's interesting.
Yeah. And the other participants were, that's a really good thing, especially to be doing now when a lot of people are wanting to shift from residential to commercial.
Yeah, totally. Well, that's what we're talking about today, diving into that topic, which obviously your real estate agent contacts were talking about. It's also been in the headlines lately, and that's this shift of investors moving away from residential property and into the commercial sector, because obviously interest rates are climbing. So, yeah, Mish, that's what we're going to break it down today, right?
Yeah, absolutely. Yeah, we are. And, a lot of people are asking, hey, have I seen the difference ever since the budget 2 weeks ago? And I think there's a lot of reluctance, I think, from investors to move either which way, because I'm having a lot of conversations, but I'm hearing a lot of them saying, oh, no, they want to know whether it's going to go through or not,
Yeah.
whether it's actually going to be voted through. And I'm just saying to them, look, we've been through these changes so often over the years. I've seen this happen so often. If you've got a residential portfolio, don't go throwing it all out the window right now in urgency.
Exactly.
Let's just see how it goes, play it out. Particularly
totally.
if you've bought residential some time ago, if anything, leverage against it and get your feet into commercial.
Yeah,
But
totally.
get educated.
I guess that's the overarching message. So I've heard a lot of people talking about commercial yields. What's driving this?
So when you say commercial yields, Sam, you're talking about the average commercial, you're buying a property at, let's say, 6%. Currently we're looking at numbers. So it's all about the numbers. In commercial, you look at the numbers first, and then you look at the building, and then you do your due diligence on building tenants' numbers, or rather numbers building tenants. So with the cash rate that's tipped to hit 4.35%, I think residential cash flow is probably going to be squeezing out a little bit. And again, it's not the first time we've hit this place. We've been here a couple of times before. Investors are looking to leverage a little bit more. And realistically, if you're going to be jumping into a commercial property right now, you could be buying a property that is just your average property at 5%, let's say. So it's not a huge yield cash flow deal right now, but it's all about the tenants and it's all about the returns later down the line. And the good thing with commercial versus residential is that in residential, you cannot see what your yields are going to be in 2 or 3 years' time. Whereas in commercial, you can, based on incremental increases, based on uplift, based on market increases, on rental reviews, on all of that kind of thing. So I'm saying to people, if you're buying commercial right now, buy a really good asset, and even if your yield is a little bit tight, you're buying an asset for long-term hold and keep. And that's where you're going to get the benefit out of commercial. Commercial is not a quick flip. It's not a quick in and out sort of thing. So it's a huge mental shift. You cannot treat a warehouse or an office or a commercial property like a suburban home. It's a totally different mental shift.
That is a really great point. But for someone used to residential, what's the single biggest difference in how the properties or the commercial properties are actually valued?
Very simple, very, very simple. In residential, valuers would look at comparable sales. So the comparable sales drive the market in the area. All right. So what did the house next door sell for? In
Yep.
commercial, you're looking at everything in the kitchen sink. So the value is driven almost entirely by the rental income and the strength of the tenant of that rent. So,
Mm-hmm.
for instance, in commercial, they're going to apply a capitalization rate, which is the income. And this is where you find the value. And it's a fundamental metric that estimates the expected annual rate of return. So it's not the rate of return right now, it's the expected rate of return, which basically looks forward. So it's a projection of what the income is going to be. So, for instance, like I was saying, if you're buying a property at 5% net now, the projected rate after incremental increases in 5 years could push that property up to 7.5% and or more, depending on what your rental in is. So it's slightly different to what the yield is.
What if someone is trying to purchase or sell a commercial property that doesn't have a tenant then?
Well, that would be considered a vacant property. All right. And a vacant property would be valuated by comparable sales
Okay.
and cost per square meter. So, in other words, what is the cost of square meter of that existing vacant property? Now, the thing with a vacant property is you've got risk and you've got reward. So, your risk is that you're going to sit on that property for a number of months until you can put a very aggressive campaign in, get a new tenant in there. And the uplift could be that you could add maybe $10,000 to the rent.
Mm-hmm.
Which means that if you're buying a vacant property that is currently rated at, let's say, $63,000, and it takes you 3 to 6 months to find another rental, and maybe you give it a lick of play, clean it up or do something to it, and put another tenant in there for 73,000, you've just increased the value of that property by virtue of the fact that it's a multiplier of that rental. Okay, because every small increase in rent, every tiny little bit of rent makes a massive difference. It's kind of disproportionate to the impact of the worth of the property. So it's very,
Mm-hmm.
very rent driven.
Yeah, okay.
It's a great question because often I try and explain to people that for every $1 that you're getting additional rent for, if your property is yielding 6%, I can't remember the multiplier now, but I think it's about $60 additional on the value of your property. So it adds tremendous value to the value of your property for every $1. So if you do the multiplier of 10, 100, you can see it goes up into the thousands that the property increases by. And I've actually got some case studies that we've done, that we've taken same like for like properties, and we've done the multiplier to show you exactly how much additional rental adds to the value of the property. So, for instance, we bought a property for $2 million, uplifted the rentals, and we did very little to the building. We just cleaned it out. We added took the rental up to about 100,000, sold that property for 3.2 million.
Oh, wow.
By value of the rent.
Yeah, okay.
Okay. I don't have the exact numbers in front of me, but it's just a quick example of how you can add value by tweaking the rent.
And is that what you talk about when you say the lease is the asset?
Very much so. So when you're buying residential, you're buying bricks and mortar, you're buying the construction, you're buying the roof, and you're buying the environment. So where you are, is it a nice neighborhood, all that kind of thing. When you're looking at commercial, you're looking at that, plus you're looking at the lease. So the lease really does become the asset. Your tenant actually is the asset. So building is, I don't want to say the building's secondary, but it almost is secondary, because when I say run the numbers, It's all about how much rent can you get out of this tenant in that building. Is the building good, solid, safe, and secure? So you're doing all your due diligence on the building, but it's imperative that you're doing due diligence on the tenant, the longevity on the tenant. So the longer the tenant's staying there, if they've got a 4% incremental increase, happy days. And you really are valuing the quality of the income. If the tenant is maybe a struggling tenant, you need to pick that up. So when you're doing your due diligence, you pick that up. If they're financially strong, happy days, you've got a great tenant.
Yeah.
And then again, of course, what sort of security has the tenant put down? Bank guarantees, bonds. We don't like personal guarantees. Heads up. Or directors' guarantees. Generally, I'm not really in favor of those. They're a little bit loose. But yeah, money in the bank. Money talks, BS walks.
I like that. I'm going to use that. I've not heard that before. I have plenty of situations I can use that one in.
That's the fact. Show us the money.
Exactly.
And Sam, the other thing that we also look at is the WALE, so the weighted average lease expiry, which is the length of the lease. Bearing in mind that a commercial lease is a legal binding document. So in residential, your tenant can get out of the lease very easily. In commercial, it's not that easy.
No, it is not.
Because it's tied directly to their business,
Yeah.
So you want to look at the length of the lease in that sort of regard.
Yeah. So you're talking about that that lease really being the asset. Now, I've actually seen some listings that promise guaranteed rental returns. And I've often thought that sounds like a bit of a safe bet for a beginner, but then it also kind of brings up thoughts like, can you really guarantee rental returns?
It depends if somebody's got a crystal ball.
Yeah. Okay. Anyone that's got a crystal ball, let's connect.
Look, there's swings and roundabouts. You can, to a certain extent, depending on the type of asset, depending on the demand. So, if you're looking at vacancy rates and take-up rates, so these are things that we would look at. We would do vacancy rate is determined by how many vacant properties would be in that area for that type of property. So, for instance, in an area, you might have vacancy in retail. However, you've got 2% vacancy in industrial, which means that your vacancy rate is going to be different per type of asset.
Yeah.
In retail, maybe your vacancy rate is 7 or 8%, where in commercial or industrial, it's maybe 2%. So you know that you want to be more in commercial. Okay. Yep. It's going to be highly sought after. Your price is going to be a little bit higher. Your risk is higher in retail, and your price is going to be a little bit lower. So guaranteed rental returns, if an agent is saying, I'll give you guaranteed rental returns, ask them what they're basing it on, where it's coming from. So it's a little bit of buyers beware, and where do those guarantees, what have they factored in to give you a purchase price? Bearing in mind, and this is a red flag, if it's a lease back, so in other words, if the owner of the business has leased the property to themselves, red flag, okay? And the reason for that is if they've bolstered that lease to be at the top end of the market, it means that the value of the property is going to be at the top end of the market. So what you really want to do is, if you're buying a lease back, is check to see that rental really is market relative. And you can almost wiggle and negotiate it down slightly so that you're ensuring that you're buying the property at the right price, even if it is a lease bank.
Yeah, that totally makes sense. Now, I know, and I've often talked about it on this podcast, that you are the expert in commercial. It is absolutely not me. I know more about residential. And one of the things that, as someone that understands residential and has paid for commercial, I know that people love the idea of the tenant paying for things like rates and insurance and maintenance, where obviously in residential that's not the case. Is it, what I've always wanted to know, is it always actually that simple?
Look, Sam, it's six of one, half a dozen of the other. And this is where you need to have somebody who knows what they're doing to do a real analysis of the lease to ensure that the sweetener in commercial is if you've got a triple net lease. What that means is that the tenant pays for everything, including land tax. So they would pay insurance, maintenance, rates, land tax, outgoings, everything. They pay for everything, absolutely everything. So the rent that you're receiving is a true net rent, and you've got no additional costs on top of that. However, that's all in the lease. So you really need to analyze that lease and ensure, because sometimes there's small print where they might say 100% outgoings, but the landlord needs to pay 50% land tax, or the landlord needs to pay percentage of. So I've seen some very complicated leases where landlord is responsible for percentages of certain things. In fact, there's a cracker one that we had a look at the other day. Got to tell you this. It's a property that we ended up buying, hell of a nice property. It was a land bank property, so it wasn't a great property itself, but it was a beautiful position, and everything around it is being developed and built. And I said to the client, you really are land banking by buying this. And the bonus was it was a brilliant tenant with a 5+5 year on it. Okay. When we started reading the lease, turns out that the lease was a lease back. So in other words, the owner of the business had created this lease, and everything in the lease was owned by the owner of the building. So in other words, it was a repair shop. All the equipment, the tools, the jacks, the pumps, everything belonged to the building.
Oh.
So he sold the business to somebody, and I don't know whether that somebody checked the lease, but that somebody inherited that lease with all of these components, which means that actually he was renting all that equipment from the owner of the building.
Oh.
Now, there's the catch. He bought the business. Our client bought the building, and when we sat down and had a look at it, we said to the client, well, actually, you own a business because you own the data, you own the equipment, you own the tools, you own the jacks, you own everything as part of that building.
Wow.
So in that case, happy days for the owner who owns the building and everything else. But, for the lessor, I think it was a tricky little situation.
Yeah, totally. Really need to read the leases, which we all, or the paperwork, we all know, but wow, got to really look.
So you really got to analyze that lease. Look, that one worked in the owner's favor. Sometimes it works in the opposite direction. We've had leases before that are brilliant leases. They look absolutely fine. And then we find little clauses in clause 3.8.2.3, which is really very,
I've read those. Yeah.
Where there's a little escape clause in there that says, that the tenant could give you 6 months notice, which means that the lease is worth nothing because the tenant can give you 6 month notice and move out.
Yeah, totally.
And it's buried, and those little things are buried. So, heed caution, really make sure that things are
totally. Now, you're talking about the lease being the asset, but if we're looking for long-term wealth, where does the growth come from, I guess, over the years? Because maybe a neighborhood might be popular or less popular, down the track. Like where does that growth come from?
Look, Sam, there are a couple of things where it would come into. So, yes, it would be the lease. So it would be baked into the lease, let's say, which would be an incremental increase of either CPI or 3% or 4%, whatever it is. And then you've got compounding value because it's tied into the income. And every time the rent goes up, the capital value of the building goes up, like I explained earlier. But not only that, that would be, you've got market growth and then you've got capital growth. So what we're talking about here is capital growth. Then you have a look at market growth. And I'll give you an example of that one. Also, one of our properties was a 5-year lease on the property. And what happened is in that period of 5 years, their lease was going up on an incremental, I think it was a 3 or 3.5%. But after 5 years, the value of the properties in that area had escalated to such an extent that there was a shortage of that type of property, and the average rental in that area had gone up by about 10%. So we sat down with the tenant, and the conversation was, look, here is a market review. You can get your own market reviews. These are the cost per square meter of your rental. It's gone up by this amount. And we had to renegotiate that lease completely. So the lease went up. We didn't push it to 10%. We pushed it probably to about 7%. And we factored in a 4% incremental increase. But what that did for the property is it took a $2 million property, and once we'd renegotiated that lease for another 5 plus 5, the value of that property went up $700,000.
Wow.
Just by negotiating that lease to market value.
Wow. I find that super interesting how that all works. Yeah, that's cool.
You can't do that in residential, can you? Unless you're doing major uplift.
Yeah, totally. It's just it's very different. I guess that's the bottom line of that story. What's the scary part of commercial? Like, what I'm trying to say is, what's the biggest risk that people overlook?
Look, I think the biggest risk that people are always worried about is vacancy.
Yeah.
Okay. So, and that's why I say buy in good areas, buy in growing areas, rather buy a property today that is a great property in a good area, pay more for it. So buy it at 4% or 5% or whatever it is, knowing that the area is going to escalate, the property is going to escalate over time, and you're going to recover a lot faster, and you're going to have longevity in it. So you're looking for properties with a low vacancy rate, really. If a house goes vacant, you might find a new tenant in maybe 2 weeks. If a commercial property sits empty for a month or 3 months, those are holding costs. So when we factor in cost of property, you've always got to consider how long you can hold that property vacant for your cost of the property.
Yeah, that's something that's always been top of my mind with commercial, that's for sure.
Yeah. And look, there are various different ways to mitigate those risks. And if you know what you're doing and how you're doing it, I always say, don't skimp. If you're looking for a tenant, incentivize the best rental agent. Find rental agents, not sales agents, and incentivize them. Double their commission if you need to. Really get them hungry so that they're really, really pushing your property and getting your property rented out.
Yeah. So if an investor is listening to this, Mish, and thinking about making that jump from residential to commercial, what's your final piece of advice, or some advice that would really, wrap up this episode into a neat little gift box with a bow on top? Because you did talk about a mental shift that, right at the beginning. So does that come into this piece of advice?
Absolutely, Sam. Get educated. That's number one. Get educated. Speak to somebody, anybody, buyer's agent, whatever. I mean, you're not going to get that kind of education, I think, from agents, because agents just want to sell.
Yeah, of course. Yeah.
We do run an education program. We do run a mentoring program where I walk you through the risks and rewards. And it's not a matter of just looking at areas in bricks and mortar. It's a matter of knowing how to look at the business, of the rentals, of analyzing rentals numbers. Commercials, all about the numbers. It's all about analyzing the lease, the structure of the lease, the economic drivers, what's driving the business. Is it a business that is sustainable? Evaluating the resilience of that specific tenant and their income stream, longevity. Transition from landlord to mindset, to an investor's mindset. Commercial property is a fantastic way to build sustainable wealth, but you need to be doing it correctly, and you need to be doing it with the right tools in your toolbox. So go into it having somebody hold your hand, or read up every single book you can find about it. Get educated.
Yeah. Love it, love it, love it. Mish, thanks for cutting through this topic again, cutting through all the jargon so that we can understand. And if people listening want to know more about where they can get more information, so where they can get educated, how do they reach you?
Definitely jump onto the website, Sam. We've got a load of information there. We've got a wealth grow plan. Book a call, book a meeting with me, a 15-minute little call, and I can tell you whether you're on the right track or not. And if you're not, maybe I can put you on the right track. We've got a lot of people that phone in, and straight away I can say to you, look, I don't think you're ready for commercial, but let me help you out in residential, put you in the right direction. We've got portfolio picks that you can click on, go through, have a look at various different types of properties. I'm very strong on due diligence. I love due diligence. So I've written a book on due diligence. There's case studies, there's blogs, there's investor clubs, and get educated. There's programs that you can click on. And if you really are interested in getting your feet dirty, then jump onto the mentoring program. Ask Mish, Q&As, reach out. I love talking this stuff. I drive everybody crazy because all I talk about is commercial.
Well, that's the kind of person that we want to speak to if we've got questions about commercial, right?
Absolutely, Sam. Absolutely. I'm speaking to developers all the time. I'm seeing opportunities. There's just so much that's happening at the moment. So,
yes, so much information. So definitely the links will be in the show notes below wherever you're listening right now. So jump on, have a look through. And Mish, thanks again for sharing the information today, and look forward to seeing you on the next episode of Revolve Commercial.
Always love talking commercial, Sam. Thank you so much for being my fabulous co-host.
Such a pleasure.